Hello, listeners, and welcome to the Montel Weekly Podcast, bringing you energy matters in an informal setting. This week, we return to gas. European gas prices have dropped from multi-year highs to trade around €50 a megawatt hour, which is, of course, relatively high put in a historic perspective. As we've discussed before on the pod, Europe has been saved by mild weather this winter. But are we out of the woods yet? Is the energy crisis over? And what's in store for the coming months? Helping me, Richard Sverrisson, to talk about what is currently driving gas prices and what we need to watch out for in the year ahead is our old friend Wayne Bryan of London Stock Exchange Group. A warm welcome to you, Wayne.
Good morning, Richard. Always a pleasure.
Okay. How are you doing?
Not too bad, thanks. Yeah. Quite busy, but we obviously lost a lot of the volatility we observed sort of last year. So no, things are a little bit quiet, and we're just preparing some research for the proper month and seasonal outlook. Because the winter season, as we know, is ending in literally 5 weeks' time. So yeah, we're already looking forward.
Excellent. So we've caught you at a good time then. Brilliant.
Indeed.
So are we out of the energy crisis, would you say, Wayne? Can we relax now and just wait for prices to fall?
I think relax is probably a little bit strong, but we've actually, we've done pretty well. I mean, if you look at what's been happening, I think, firstly, the surprising adherence to the EU's call to reduce consumption has been a big factor. The mild weather, of course, is really weighed. And I think if you look, I think 2022 was one of the warmest years on record. And of course, we've seen this steady stream of LNG imports, notably from the US. And that in tandem has helped us fill the storages. So we've had, a lot of, soft, bearish fundamentals that have helped bring prices down. And if you look where we've been in the last sort of 3 to 4 weeks, pretty much range bound up here, down there. And we've seen that over the last few days as well. The market's barely moved, just a few intra-week swings at the moment, really. And things have actually, converged. If you look at all the European hubs, there's big differences in the location spreads a few months ago. And if you look now, they're all pretty much harmonized across Europe. So it tells you that we're kind of out the woods for the time being. And things are a lot more optimistic than they were sort of last October. I think IEA did something yesterday. I saw the Fatty said that, I think the crisis has eased so far. So things are definitely in a much better place for the European gas.
They've eased, but I think probably be a bit premature to say it's completely over.
No, it's far from it. There's always something that can, happen, and sort of, history teaches us that don't get too complacent in these gas markets. Something can always happen, no matter how rosy the outlook appears. So we're waiting to see what's next, but at the moment, fundamentals pretty stable, geopolitical is pretty stable. So
there's always a spanner waiting to be thrown into the works, isn't there?
Or a pipeline to be blown up. So.
Exactly. So as you mentioned, Wayne, we've seen, there seems to be the same kind of price that we see across hubs in Europe, which is around 50, 55. Where is the floor, would you say?
Well, you say floor. I think we're around that sort of level now in terms of, if you look at what the market's been doing, if you especially look at the MBP TTF, they've just been bouncing off that sort of line. And I think the big number, I'll do a bit of technical analysis as well, and they've also been pointing towards pretty much range-bound trading, no real signals. But I think looking at where we see prices would like to break, if you look at the sort of August 21, we've been bouncing off that low. And again, that is around the 49.50 euros per megawatt hour. So, and typically as well, whole numbers attract a lot of activity. So if a break of 50 happens, we could see further bearishness. But you can kind of see the market has sort of reached a floor at the moment, which is when you look back at what's happened and you look at the injection season about to start, and injection demand is going to be a lot lower than we probably first thought at the end of winter. And again, if you look at the spread, I think we've spoke about that before. At the peak, summer was trading, I think, about 20 euros above winter. And if you look now, live, it's about 7 euros discount. So that has also shows you the sort of confidence the market has around that summer. And all the risk now, if you look on a price basis, is in the winter. I think winter's at 61 euros, and all the other contracts, whether that's front month, front quarter, day ahead, they're all trading within a 2 euro range. So they've converged as well. And again, that kind of gives you a view of where the market is right now.
And of course, it's important to bear in mind the global picture as increasingly gas becomes a global market, Wayne. So, I mean, what's happening in the East? What about the JKM or the Japan-Korea market? What are the prices there, and also in the US?
Well, TTF, if you look, is still trading slightly above the JKM. I think it's by about $2 per MMBTU. US prices have also suffered from the same sort of factors as the European market. Quite a mild winter, storage is close to fullness. You had the Freeport outage, which kept more gas in the US system, and air prices have also been quite soft as well. So I think looking at it, Europe is still the premium market. But I don't think we will need that gas as much later on in the year if these conditions continue, because if we look in our research, and I mentioned we're doing our latest 12-month research at the moment, but if we look back at the last one, and even I don't think it's going to change massively, we saw storages in Northwest Europe is being close to fullness by July, August, if all the current fundamentals and supply remains in place as we think. And I think when we rerun that the next day or two, I think we'll probably see a similar situation. Even in the event of a serious cold snap, we still see storages close to fullness by the start of the winter season. So again, this optimism is sort of backed up when you look at the sort of hard numbers behind it as well.
No, that's very interesting. I mean, I think so you would say, as Europe is the premium market, will still be attracting LNG for the coming months. I mean,
price-wise, definitely, yeah. And also you look at in sort of Asia now, temperatures I think are slightly above normal. And I think the probability of a cold next month or the remainder of this month is quite low. So, and Chinese demand still hasn't recovered. You've seen a bit of a increase in sort of demand for some of the price-sensitive importers, because prices, as you know, have fallen in LNG as well. So I think at the moment, and if you look at the arrival schedule, there's still quite a lot of cargoes arriving in Northwest Europe, notably from the US, who really stepped up, and Freeport's back now. See a few, I think there was looking yesterday, there was like 4 or 5 cargoes hanging around that side of the terminal for loading. So we expect further deliveries from that into Northwest Europe. The outage at sort of Gate and Eemshaven's ended, more send out from there. Brunsbüttel started. So, things are really picking up in terms of supply side. So I think Europe will continue, but at some point we might not need as much LNG. So price signals might have to start falling to disincentivize.
There could be too much of a good thing if you like, Wayne. But
yes, indeed. But we've still got coal to gas switching, which we're starting to get into that sort of area now, where we should see some coal to gas switching, which will further boost gas demand.
Well, this week Shell came out and said that Europe faces stiff competition with Asia for LNG right for the next until 2025. Is that something that you'd agree with?
I agree in terms of if we see Chinese demand return, which we still think it will. I still think we'll definitely be in competition. And like I mentioned, there are a couple of dollars in the spreads now between Europe and Asia. So definitely will remain in competition, but it depends on the fundamentals as well. It depends on the weather. It depends on Europe's needs. It depends on Asian needs, really. It probably hinges quite a lot on China and how fast they're going to recover. But if you saw, I think it was CNOC, they said that Chinese actual demand will probably grow by about 7% this year, which isn't huge. And you think last year it fell. We saw probably about a 20% fall in LNG and 10% increase in pipeline imports. So I think the Power Siberia will continue to ramp up as well. So there's a few uncertainties in the global economy, even though things are looking better. Still, inflation's still quite high in a lot of places. There's still quite a lot of pressure. So that might impact as well. But I think in terms of the competition, that will continue, but it depends on the fundamentals of each market and how that develops over the coming months.
Absolutely. So if I could pin you down, Wayne, I mean, when do you expect Chinese demand to pick up as to maybe to pre-crisis levels or even pre-pandemic levels?
Pre-pandemic levels could be a bit of a struggle, but I think in terms of sort of last year, I think we might start to see the pickup when perhaps, sort of cooling season starts to begin, or, a bit later on in sort of April, May, we might start to see a pickup. And look at the economic numbers now, it's still not great what's coming out of China. So nothing immediate to impact our sort of supply prospects over the next month or so.
No, that's interesting. So that also adds maybe to the optimistic picture in Europe. But what? So you expect these, to remain around €50 for the coming month?
Range band,
yeah.
Barring any disruptions. I mean, you saw, I think yesterday, prices went up a little bit. A bit of cold weather support, bit of a colder sort of March. We've seen some below normal forecasts. The EC 45-day forecast will be interesting this evening. And again, on the supply side, you saw a few outages in Norway. I think Dvalin field got postponed again for another month. But again, if you look today, we've paired them losses, or supply paired them gains, and we're down 2 to 3% across the GTF curve today. So again, it feeds into this short-term movements in price, but still it's not going anywhere. And I think that's the point. If you sort of look at the TTF front month, last traded, let me just see, the last trade was around 52. And yet if you go back to the 26th of January, it's 54.
Okay.
And in between there, I think we've seen, the max of 59 and minimum of 51. So it's an €8 spread over the last, like 12 sessions or so. So it kind of shows you this up one day, down the next. It's just short-term fluctuations, but really we're going nowhere. We've gone a little bit down, and that's it.
Absolutely. So we're recording this on Thursday morning, listeners. But so as
yes,
but just to make that clear. But we've talked a little bit about Chinese demand. But there have been a lot of headlines coming out this week and over the course of 2023 about the demand destruction in 2022. With actually levels, up to 25% drop in some areas, or even Finland, even more, even almost more than 50%, I think. So, yeah, so although maybe the gas consumption is not that large there compared with the big European countries, but what is so? How much can we say? What is your analysis? What do your numbers show, Wayne, about demand destruction in Europe, and which sectors have been most hit?
And obviously the industrial sector's been hit quite strongly, and that's due to several reasons. High price curtailing, obviously, production. Also, we've seen some big players move operations outside of the EU to avoid such high prices. We've seen some businesses close as a result of the high price environment and obviously the inflationary pressures. All the sort of price inputs, everything's been going up, so that's also happened. But again, if we've got a page on our product that looks at demand destruction, and I was looking at it again earlier, and on our average 6-month rolling average for Europe, or the EU, for Northwest Europe, let's rephrase that, is around 16%. That's the current 6-month rolling average, which is quite interesting when you think of the EU. Their adherence was, they were talking 15%, so it's quite interesting. But if you break it down to countries, we've seen the Netherlands is quite strong at 25%, and you mentioned Italy there, 20% as well. Germany, France, 17%. So we've seen the callers, the people have listened, but some of that, again, don't forget, is due to the weather. I mentioned at the start of the show, I think 2022 is one of the warmest on record. So I think we kind of got away with one in terms of, yes, we saw demand destruction, but a lot of this was triggered by soft heating demand, which really fed into the demand destruction. But yeah, the industrial sector has been massively hit. You look at chemicals, papers, bricks, ceramics, all these sort of heavy energy intensive industries have dialed down production, but we've seen that sort of pick up of late. We've seen that as prices have started to adjust lower, some of these productions have been coming back. And if the economic, or the European economic prospects increase, then you expect further increases. And I saw in the latest PMIs, a little bit of optimism, still showing some contraction, but there's a bit more optimism than there was, say, 6 months ago. And that, again, feeds into potentially demand rising over the coming months. And that could also, as I mentioned, fit well for Asia or China in particular as well, as global conditions increase. But we're still not, as we said, out of the woods yet. So
you'd expect then some of this demand to come back this year? Is that what you're saying, Wayne?
Yeah, potentially. Yeah, potentially if economic conditions, improve, prices continue to adjust lower, then yes, you'd expect industrials to sort of ramp up production. But we've definitely lost some as well, as I mentioned. Quite a few companies have, shuttered operations or moved them, and you see BASF and companies like that talking about moving operations, reducing reliance on gas-fired generation, etc. So yeah, it's kind of a bit of both really, but aggregate we'd expect industrial demand to start to pick up later on in the year.
What would be the impact on prices then, Wayne? I mean, if you expect demand picking up, would then we see an uptick?
Potentially, but again, it depends on the timing of all the. When will this demand start to increase? Where will the market be at the time? Will supply be ample? Will LNG still be coming, etc.? So there's numerous factors that will feed into that, but generally looking at the market overall, and as I've said earlier, looking at storage prospects, etc., we're looking in quite a comfortable place. So even a slight uptick in demand of industrials is not going to be the end of the world if the supply side fundamentals are stable.
So what would it take to trigger a price crash or even a price spike and when?
Well, I think the loss of Norwegian volumes, and it's funny, we had a client ask us a similar question last week, actually, what would happen if, and that was the sort of getting into that scenario of, what could be the next thing that would force a huge price spike. And I think for us, it would be Norway, because that we would not be able to do that. If Norwegian supply, is curtailed or there's an explosion on the pipeline. And I saw actually the Norwegians were talking about this, and they've stepped up security across their platforms, and they expect Russian drone activity, etc., to increase. So I think that is probably the big thing in the market now that could push prices back even above where we were perhaps in August, if we had something that really heavily impacted Norwegian flow. Similar story for the UK continental shelf as well. But I don't think the price upside would be quite as bullish or catastrophic as it would be if we had NCS problems. But still, so any sort of disruption to these supplies for me would be catastrophic for the market, completely catastrophic.
The outage season or maintenance season, as maybe is a better way to put it, in around May, June for Norwegian gas fields. So has that kind of been priced in already?
Well, as you know, Gasco release a lot of this in advance, and we already know that this summer is going to be one of the strongest maintenance periods in Norway, and there's quite heavy Norwegian maintenance this summer. So that, it's priced in because a lot of this is, obviously announced in advance. However, if we do see some of these actual, outages extended or further problems, etc., then perhaps we could have some issues. But as it stands now, that maintenance is known, and again, it is quite strong. But again, looking at the current supply side situation, it's not something to be that concerned of at the moment. But things may change. Things can always change, as we keep saying. Things can always change.
Always change. There's that spanner that could be thrown in.
There's always a spanner ready to cause some problems for us. And I'm just looking now at this latest forecast for Norwegian maintenance, and it's quite strong. I think in September, especially.
In September,
really strong in September, which again is kind of you could have some risk in there that any of these maintenance extend or further problems just as we're about to head into the winter season. But I think by then storages will be in a great situation anyway, is my personal opinion.
Absolutely.
And our research
we're talking about
that.
So we've talked about supply from Norway. What about supply from the east, Russian gas flows, Wayne? I mean, they've sort of gradually been trickling down. Do you expect these to come just to a full stop, or what's the outlook here? Are they important at all anymore?
No, I don't think. It's quite surprising that going back to where we were when these flows were curtailed, especially Nord Stream 1, and everyone was aghast, thinking this is what is going to happen. We're going to run out of gas, shortages. So much concerns, but the speed of the sort of infrastructure, LNG additions and capacity, FSRUs, has sort of taken everyone by surprise. And the fact we've managed to really cope reasonably well without Russian gas. Of course, we've got, what's coming through Velke, Kapushalny. I mean, it's ramped up a little bit to 300 gigawatt hours the last couple of days, but overall it's been weak. And trickle is the right word. Obviously, Southern Europe still gets Russian supplies, but for us here in Northwest Europe, we're quite, say over it's the wrong word, but we're managing well. We're managing very well. So the sort of the narrative around, remember before it was looking at Russian capacity auctions, wondering if these turbines are going to come back and get put in. All of these concerns now are sort of in the rear view mirror. But again, I hark back to what I said earlier. We kind of got away with one in terms of the weather over the winter. So that in conjunction with this significant ramp up in LNG import capacity has really helped us, really wean ourselves off, Russian gas. So for me at the moment, it's not something that's on my radar on a daily basis, whereas before it consumed most of our day.
No, I mean, it's been fascinating to see how quickly Europe has
It's incredible.
Pretty much has weaned itself off Russian gas.
It's incredible. Yeah.
I mean, you hear several voices out there, heads of utilities, regulators, government officials saying that Putin has lost the energy war. Is that something you'd agree with, Wayne?
I'd be a bit. I'm looking at the profit margins. I'd be a bit. I wouldn't quite say they've lost the energy war, but I tell you what, they're going to have some problems over the coming years in terms of that loss of the European market and where to put them excess volumes. And you've already seen additional flarings been going on. The storages there are relatively full. They're going to try and send a lot of it to Asia. I think Putin's been a little bit of a roadshow trying to, create some sort of further gas alliances in some of the other countries. So yeah, I think they're going to struggle, Gazprom especially over the coming years.
I mean, I'd like to sort of round off by talking about some of the regulatory issues or some of the regulatory interventions we've seen in recent months, Wayne. And in a way, of course, as we've talked about on the pod before, it's understandable given the high price environment that government officials, European Commission want to be seen to shielding consumers, both industrial and households, from these very high prices amidst the cost of living crisis, amidst energy poverty. But one of the measures was the price cap on gas, which started this week. Well, what's your view here, Wayne?
When you look at this price cap now, I mean, it started yesterday, and the price cap is 180 euros per megawatt hour. TTF front month is trading at 53 euros per megawatt hour. This price cap for me is mute. It's a pointless price cap at these prices. And if you look back, I think it's been over 180 euros around 54 times. And most of that was concentrated around sort of February, when the invasion started for a couple of days. And of course, we had a sustained period sort of in August when Nord Stream issues were going down and the full suspension, where we hit the all-time peak. And then since then, we've not been over the 180 mark since November. So we're now in February, we're at 52 euros. So for me, tell me the point of the price cap and what would take the market to 180 euros now. I mean, that's a tremendous rise. It would need some serious supply disruptions or, I don't know, a sudden stratospheric warning, which there is a bit of a risk of at the moment, coming in engulfing Europe for like 2-3 months. I mean, so that for me makes it mute. And we said this at the time, I think I might have probably before, and I said, it's still too high. It doesn't do anything. And now you've seen ICE is setting up an alternative base in London. So when the price does go near around that, you can actually trade above it because you're not bound by the EU rules. So ICE have already made moves to sort of help people get around that. And someone said to me yesterday, is the price up due to the price cap? And I think no, most certainly not. So this price cap at the moment is irrelevant. I mean, you talk to me when it gets to 160 and perhaps with a bit more comment, but when it's at 52, and I don't see any prospects in the short term of TTF going anywhere near 180 euros a megawatt hour, this for me is irrelevant, this price cap. And again, it was decided by people who don't really have too much experience of these markets, it seems, and the number they provided sort of backs up.
And it was a very kind of arbitrary figure, wasn't it? I mean, but
yeah, but the first one was higher than that anyway. Do you remember the first number was even higher, which was more laughable. But this 180 is going to take a lot. So for me, no impact on the market at the moment whatsoever.
So it's largely due to pressure from southern European countries who felt that the prices in Northwest Europe were artificially high. But would you still think that, the TTF price and the price index, the wholesale gas market is fit for purpose?
I believe so. And I think if you look at how the market is now, I mean, it's supply demand is what moves this market. And at the moment, we had these at the time when the market was at these, astronomical prices and we hit the all-time highs, August 26, 27. and even the week before and after that, the weeks preceding that, and after that, yes, high prices. The market was crazy, but it reflected what was going on at the time in terms of the supply risk. Of course, some people can say it was artificially high, but at the time, it was some serious risk to European gas markets, which is why the price was where it was. But look where we are now. Normal functioning market, prices, have adjusted lower in line with the fundamentals. So that to me seems like a functioning market to me. So we've lost a bit of liquidity and stuff, but that has happened due to this high price environment. A lot of people, out of the money, and we saw a few suppliers and a few operations shut down. But now we see this price, it sort of reflects where we are in the market. So I don't think the TTF is broken. I think at some points it might be open to manipulation, which we saw that with, when the prices got to the all-time high. But I don't say this market is broken, definitely not. And I think if we did get back up towards these levels, you can say at least we've got a price cap.
No, absolutely. But when the other upshot, I mean, one of the consequences of these very high prices is that the big oil and gas majors have made extreme sort of bumper profits.
Yeah,
so one after the other, BP, Shell, Equinor, Centrica, in the last few weeks. Do you expect a bit of a backlash, a public backlash here, because people are struggling to pay for food, let alone their energy bills in some parts of Europe? And, while they see these big companies making these enormous profits, do you think there's going to be increased pressure on politicians to grab, introduce some form of windfall taxes?
Well, yeah, I think it's staggering, some of the profits these companies have made. But I think if you look at countries like the UK, where we have additional taxes on oil and gas companies, Norway, as you know, is a very strong tax, and the Norwegian government done very well at Equinor over the past couple of years. And of course, one thing I would say is people always talk about, blame the suppliers for making such excess profits. I don't think anyone was worried about when it was the pandemic and TTF was €3, €2 a megawatt hour, and MBP was 4 or 5 pence. And some of these producers are definitely not making such profits in those years, and some of them are making losses. So, and they don't set the price. Remember, they didn't start the invasion of Ukraine. They didn't set this market and set this price. They're just producing gas as they would in any other year. But I do think, some of this windfalls can be, more harsher, and I think stronger taxes, and perhaps they should give some back to, which they are doing by taxes, of course. But I think some of these numbers are staggering, and perhaps it'd be good of some of these majors to perhaps, give some back. And I know Norway, for example, I think they're giving 7 billion to Ukraine. And they were saying we've had great high oil and gas revenues. We're going to, put some of this money to good use. So it would be good to see that. I don't hold my breath in terms of the other companies in Europe, but Equinor did a very good job in that respect. So it's staggering. And I see signs. I saw some graffiti the other day where, talking about this, someone that wrote, these excessive billions made by Shell, etc., don't pay your bills. So
yeah.
So people are not happy. I get friends, family members who are not in the energy industry saying, these profits, it's not fair, we're paying these bills. But again, if you look back, and they can't help such, they don't set the price of the gas, do they? Let's be honest.
No, absolutely. Wayne, we could talk for hours, of course, but we have to draw a line there. But as always, a pleasure having you on the pod, Wayne. Thank you very much.
Absolute pleasure. Have a great day.
So, listeners, you can now follow the podcast on our own Twitter account, aptly named the Montel Weekly Podcast. Please direct message any suggestions, questions, or let us know if you think you have a good idea for a guest on the show. You can also send us an email to podcast@montelnews.com. Lastly, remember to keep up to date with all that's happening in energy markets on Montel News. You can subscribe on Apple Podcasts and Spotify, or wherever you get your podcasts from. Thank you and goodbye.